The debate is heating up over how to value cryptocurrencies and whether they really benefit from network effects. Some analysts say crypto network effects show up at the infrastructure, security, and liquidity level, not with end users. So, are digital assets priced for network effects they do not have, and do congestion as well as higher fees and slower transactions actually destroy value as usage grows? Well, joining me to weigh in this morning is Santiago Roel Santos, founder and CEO of Inversion Capital. Santiago, great to have you here. Thank you so much for joining me. So first, is crypto fundamentally overvalued or just being judged by the wrong metrics?
Definitely overvalued. I would say Bitcoin is in a category of its own. It's valued like a commodity, pretends to be digital gold, but everything else in the crypto universe should be valued like a tech stock. And when you look at it through that metric, you'll hear oftentimes people compare it to social networks and have network effects, or large financial networks like Visa. And those networks and those companies are valued on cash flows. And on that basis, crypto is still very much emerging technology. And when you apply a fundamental view, it's hard to justify valuations across the board.
Yeah, and while I have you here, can you explain this in layman terms and tell us, are congestion as well as fees a sign of failure or just a growing pain that gets solved at the infra level?
I think the technology's come a long way, and no one's really discounting or arguing the potential of this technology. But to give you some perspective, Ethereum, which is the second largest crypto asset, is valued at 350 billion, and it's going to generate at most $1 billion of revenue. And so I think it's hard to make an argument that it's fairly valued when it's trading at 350 times price to sales. And you go down the list of most of these networks, and it's the same story. A lot of the technology's built, but that doesn't necessarily mean that it's going to be a good investment. And that's really the crossroads that a lot of crypto investors find themselves, which is the technology itself has been built. However, prices are really not reflective of the fundamental traction that you have. To give you an analogy, it's almost like we built these super highways for the internet, but there's not a lot of demand and there's not a lot of cars in those highways. Most of the activity on these networks today is speculative activity. And so that's really the problem that we have as an industry, which is I've been investing in crypto for the better part of a decade. Um, Back, a couple years ago, it was all kind of the promise that this technology was going to get built, and we've invested over 100 billion in infrastructure. So the roads and the highways have been built. You just don't have much cars on them, and so if you don't have cars on the highways, there's not a lot of fees to support the valuations. So, I mean, as you know, when things are priced to perfection, it leaves very little margin of safety for things to go right. And that's, I think, a lot of crypto asset prices this year have struggled, much more so than Bitcoin. And I think that's a reality that the crypto market investors kind of are waking up to.
Yeah, so Santiago, you mentioned valuation and how blockchains could be valued like consumer platforms like Meta, Facebook, or financial and security infrastructure. So if you had to put a price on crypto majors, including Bitcoin or ETH, where do you stand right now?
I'll exclude Bitcoin because I don't have a view. I mean, Bitcoin is like gold. It's just a macro asset at this point. Something like Ethereum reminds me a lot like Cisco back in the day. It never really recovered from an all-time high back in the late 90s. And that I think is true for Ethereum as well. It was first. I think a lot of people ascribe a lot of value to first mover advantages, but it is widely overvalued. And I think the value capture of these networks is not there. And I think you're probably going to have a lot of guests in here talk about the promise of the technology. And I think, it's the classical, we tend to overestimate what happens in 2 years and underestimate what can happen in 10. But I don't feel compelled to pay 380 times price to revenue for Ethereum or 100 times for Solana. And so you go down the list, and it's really hard to make sense of these valuations. And it's almost like once you grow up in the classical Silicon Valley meme, it's you should never show revenue because once you start showing revenue, the market will comp you against any other technology stock or AI stock. And there's a normal valuation for things, and it's certainly not 350 times price to revenue.
So Santiago, before I let you go, based on what you just said and based on your thesis, with per user valuations far above traditional tech, do you think this points to a crypto bubble or just a fundamental misunderstanding of where value actually accumulates?
I think you're absolutely right. The value accrual is something that's where the nuance is. A lot of crypto applications, wallets, exchanges are very profitable. Companies like Tether and Binance and Coinbase and Robinhood are capturing a lot of revenue for users that are interacting and, trading crypto assets. It's really the infrastructure players like Ethereum and other crypto networks that are not capturing that value, and that's a big distinction relative to social media networks or Google or Amazon. um, User aggregators that control the user historically have captured most of the value. It was true for the internet and it will be true for crypto. And that's really the nuance, which is as this industry continues to grow, as we see more stablecoin and user adoption, it will serve investors well to understand where value is being captured. And I think perhaps historically, a lot of analysts and investors would have thought that if layer one networks like Ethereum and Solana, Ripple, Tron, you go down the list, would have captured a lot of that value. But that you're seeing it in real time that that's not happening and likely will not continue to happen in the magnitude that investors were probably underwriting. And that's a new paradigm that a lot of investors are rudely kind of waking up to, I would say.
Okay, Santiago, well, we will have to leave it there for today, but thank you so much for joining us and thank you so much for sharing all of your insights and your perspective.
Thank you, Remy. Take care.